Hello, welcome to our April 2026 investment review and outlook. I'm Ben Hockema, founder and lead advisor here at Illuminate. We are recording this on the afternoon of April 16th, 2026. A lot of this data is going to be based upon the first quarter that ended March 31st, but there could be a few things that continue on here into April because it has been a very eventful couple of weeks that we have. We are after tax season, at least the initial filing deadline, and so that is why I'm able to record this here today. So let's jump right in to our investment review and outlook. So our topics today, we're going to focus on first, just what we normally do. We look at first quarter performance across the different asset classes. Got a breakdown of a couple different things that we're going to walk through together. Then we're going to talk about bond market takeaways. What does this mean for you as we think about it? Then we want to really dive into the Iran war and what that means for you and your portfolio. We're going to talk a little bit about software stocks as well, which will also be a part of the outlook for the rest of the year. So starting with Q1 performance, you've seen this chart before. This is looking at just broad asset classes, how they performed in the first quarter. So again, this is all ending as of March 31st. So starting, we're actually going to start at the bottom and work our way up because I think that's actually meaningful here in this case. So VTI is the total stock market index, total U.S. stock market index. So you can see that was the worst performer for the year, down 4%. So if you had 100% U.S. stocks, you would be down 4% for the first quarter. Bonds were basically flat at 0.05%. The next one up is emerging market stocks. Those were only up 0.54%. You can see that at the beginning of the Operation Epic Fury, which we'll talk about related to the war, that started basically February 28th. So before that, you had a lot of these areas were up. Emerging markets were up almost 10% right before that actually happened. So that definitely had an effect. The dollar is the next one, the dollar index. We talk about that on these videos a lot. I think it's something very misunderstood by the general public. And that's basically unchanged, up 1.7% through the end of the first quarter. Then VEU up 2.25. That is the all world ex-US. So that's basically taking all the stocks in the world minus anything in the US. What did international stocks, both developed and emerging, how do they perform? So that's up 2.25. Gold was up 8.5%. And then a broad real asset basket that we like to reference here, RLY, is an ETF that you can buy, you might have in your portfolio. That was up 15%. So real assets did really well, diversifying away, having international stocks outperform by 6% compared to the US. Tough quarter if you were just US focused. Our clients, I think, did pretty well, all things considered, given that we have a well diversified portfolio. And so diving a little bit deeper into those stock returns, the equity returns, S&P 500 for the year to date as of, again, March 31st. So Q1 down 4.3%. But in March, we're down 5%. So going into March, right before everything started to happen in the Middle East, or really step forward in the Middle East, we were up slightly for the S&P 500. One thing that I find interesting is the equal weight. So the S&P 500 is a cap-weighted index. So the biggest companies have a bigger effect on the returns than the smallest companies. The S&P 500 equal weight, that second column that we have there, is basically just equaling all 500. So each one has a 0.5% within, or 0.02% within the portfolio. And that is equal regardless of the biggest or the smallest. So that's a nice proxy to see what's driving the returns in the S&P 500. Is it the biggest companies, or is it broadly across the market? So you can see through Q1, that was actually up 0.7%, now down 6% in March. But you can see that it's really the biggest stocks that are driving the negative returns in the S&P 500 year to date. Russell 2000 is small cap stocks, so those are not going to be ones that are in the S&P 500. Those were up basically 1% for the first quarter, down again 5% in March. Then we have the EFA, or MSCI EAFE, that's developed markets essentially. That was down 1.2. From that perspective, 10% in March, and then emerging markets was basically flat for the first quarter, down 13% there in March. So these numbers are slightly different just because I use different indices here to compare. This isn't actually index. Those are the one on the previous page are ETFs that you could buy. But regardless, it was a tough March, and if we had this conversation, based on the end of February returns, things were looking a lot better before that actually happened. Another thing that happened that I mentioned before is the yield curve or the bond market shift. So this is looking at yield curve for different periods of time. So this is years to maturity using the U.S. Treasury market as our benchmark here. And so we have 0 years here at the short end of the ladder, all the way up to 30 on the long end. And so you can kind of see how, as you would expect, the longer you are locking your money away, the longer to maturity, the higher return per year that you expect to take on that liquidity risk. Now, if we go back to what we had before, let me just make sure we're speaking the same language. The top line is as of the end of the first quarter. The middle line in yellow was at the beginning of the year, and then the light blue at the bottom, that was actually what it was just a month before. So again, going back, forget March, let's go to the end of February. What did that look like? And so, as you can see, the yields across the board had shifted down from December 31st through February 27th, but then shot up even to a higher level there in March. And really, what that is suggesting is an expectation that the Fed is not going to cut rates. And that changed the whole trajectory. It also, the longer term, has to do with inflation and concerns about inflation on the long end of the ladder. So the short the short run is about Fed, long run is about inflation. All that together, we actually have what's called a normal yield curve now, which is essentially you are paid more as you move up that ladder. So, what does this do to bond returns in the short run? For March, bonds were down. Bonds lost money because when interest rates go up, price of bonds drops. However, investing at this point is going to be more profitable to you than if you invested into bonds even a month ago at this point. So this does set us up to make some nice returns on bonds moving forward. I also want to dive a little bit deeper into our real assets. These are all things, some of these you own directly, some are just proxies for different pieces. And so, again, I'll quickly walk through from the bottom up on performance through Q1. So the VNQ, that is a broad U.S. real estate basket. If you were to break that down, a lot of real estate was up more, but the office real estate was down quite a bit. I think it was down around 10% for the first quarter. So it's pretty bad with drug down returns. That's real estate. Next one up is silver, up 5.77%. If I go back to the end of January, we peaked out almost 65% here in this red line, and then it dropped off a cliff. And this humongous drop that we have here that happened really, really fast had to do with the Fed chair being named, and that was different than what the market expected and set some concerns for a stronger dollar, which would be negative for commodities like silver. And so that's why you had this really, really big fall off a cliff. Gold had a similar fall, not nearly as much, but it wasn't up as much to begin with. That again ended the first quarter up 8.5%. Uranium stocks also were up quite a bit and had dropped, and so they still ended up 15%. The broad real assets up 15, and then XLE. This is energy stocks, U.S. energy stocks. So we're talking, ExxonMobil and Chevron and things like that are in that basket. You can see that this had a nice steady up and to the right movement, and it didn't really have a major change even with the war starting and everything else. It just continued to move up. And so this is not a trigger based upon just, the Strait of Hormuz and what that looks like. This has been going on for a while, and it started actually in the end of the fourth quarter last year and has continued on. So we're really happy with having that energy stock exposure, at least for the first quarter. Then I wanted to talk briefly about software stocks. So one thing that I find really interesting is that software stocks, we're talking things like Salesforce, Microsoft is in there, Oracle's in there. So you've got quite a bit of stocks that are well-known names that are out there that really fell off throughout the first quarter. And this is actually showing you the price earnings ratio, the forward PE, price earnings ratio, which is just take current price divided by forward looking earnings to calculate really how expensive is something. And you can see historically that top line is the software stocks, the bottom line, the light blue, that is just the overall S&P 500. Those software stocks have historically traded at about a 50% premium over and above the S&P 500. That PE has been about 50% higher. But right now, as we ended the quarter, you were at basically equal. And so that contracted all the way down where the forward-looking PE for software stocks is about the same as the forward for the rest of the stock market. And again, historically, that is a dramatic difference from where it was before. And a lot of that had to do with concerns about AI. I believe the trigger of this really starting to fall was someone used Claude, one of the AI tools, to basically recreate Monday.com, which is a software that's out there for small businesses, and essentially had it all coded using AI. And so now it's become this concern that I personally believe is overblown, that all these software stocks are eventually going to go to zero. What I find very interesting is most of these companies have, during this fall in price, have actually increased their forward-looking earnings. Another way to say that is the price is dropping and their future expected earnings are going up. They're projected to make even more money than if we had this conversation 6 months ago, and yet the price is quite a bit lower. So I find this interesting, especially if we compare things like energy stocks or software stocks. The divergence in performance is around 60% for the first quarter. So by buying energy and not buying the software, you would have made 60% more. Those sort of divergences tend to work themselves out over time. And so it is something that we are looking at. Does it make sense to add a little bit more exposure to these software stocks? Buy low, because I just don't believe that this is something that would continue for the long run. This sort of uh, the premium that's been there about 50% just really fallen off a cliff. But that has led to part of why the S&P 500 has not done as well. The bigger companies are the ones that are being hurt here, and so that's been part of the story so far this year. Now, I want to quickly talk about just the Iran war, what this actually means for you as an investor, and the Strait of Hormuz. So, the first one that we're going to go through here in a second is a question of where does U.S. oil imports actually come from? And before I get there, I want you to think for a minute. What countries do you think are the reality of who is exporting oil to us in the U.S.? So, on the left is based on a survey, pulling data from January of last year, actually, on where do we think it comes from. And so the numbers came out 53% Saudi Arabia, 22% Canada, 9% Russia, and then 7% in Venezuela and Mexico. The reality there on the right is actually what happens, which is 62% of our imported oil is from Canada. Saudi Arabia is only 4%. And that change is part of why, from a stock market perspective here in the US, I'm not as concerned. And it'll be interesting to see how this all shakes out. There is definitely an impact of shutting down the strait and what that looks like. But we are actually somewhat insulated here in the US. Now, we've seen oil prices go up, but the countries that have been hurt more are actually mostly in Asia. And that's part of why emerging market stocks were down so much. So, here on our next slide, this is just showing you how much over time where the crude oil goes when it passes through the Strait of Hormuz. And so you see China's that first bar that we have, that's a large percentage of the total amount. Then we have India, South Korea, Japan, other Asian countries. The United States is that little sliver there in the dark green at the top that's out there. There's just not a lot that's going through that's coming here to the US. And so this tells us a couple different things. Part of this is why have emerging markets and other international stocks really struggled in March was because of this chart here. There's an effect on the economy and what you would expect. And it also tells us why here in the US, I'm not super concerned on long term fallout from closing of the strait or things like that. And another way to look at this is when there are geopolitical events that lead to sell offs, yes, there's a sell off, but we recover typically pretty fast. And even if you don't, um, investing over the long run and buying when everyone's panicking and selling off is typically a great way to invest. And so this is looking across 30 geopolitical risk events that started in 1939 with the start of World War II. And then looking at what happens, when do we bottom out from the start of the event to the end? How long does it take to recover? Number of trading days? How big was the sell off? And then looking in the future, 1 week from the bottom, a month from the bottom, 3 months, and 12 months from the bottom. So just to keep this in mind, when we talk about trading days, there's about 250 trading days in a calendar year. Because obviously we're not trading every day. You've got weekends and holidays that are off, and so 250 is a full year. And so you can see some of these big ones. They pulled out some subsets. So we have Pearl Harbor took 17 days from the bombing on December 7th, 17 trading days until the market bottomed. It did not fully recover for a full 200 after that bottom. And so that is almost a year. And the size of the sell off was almost 11%. But if you were to invest on the way down and you were 1 week from the bottom, up 8%, up 6.5 a month later, down 3.8 3 months later, but still up 15% a year later. So you can see that um, there's a lot of noisiness here, but overall the trend is positive, similar to what we would expect in any other market environment. We expect the stock market to be down 25% of the time, up 75%. Those losses can happen fast and you can lose money, but if you stay invested long enough, we do expect to recover. If we go to the very bottom, in the sharpest sell off scenario, markets were down 26% in 3 weeks from the start of World War II. And it took 2.5 years, almost 3 years, 700 trading days for that to fully recover. So that doesn't mean this happens overnight, but again, investing through a tumultuous time period doesn't have to be, and actually we would expect it wouldn't lead to negative returns in the long run. So, as we talk about the rest of the year, there's a couple of big themes that come out that jump out to me. So, one we already kind of talked about. It'll be interesting to see what happens with software stocks versus energy, the two uh, biggest outperformer and underperformer for the year so far. That'll be interesting to see. Obviously, what's going on in the Middle East. If there are other geopolitical arenas that come into play, that'll be something that will definitely affect the market. But I really want to focus on three charts to finish us out that give me a lot of confidence and optimism going into the rest of the year. And so the first one is the U.S. consumer remains very resilient, and so we can see this is just real sales over time. We've got a recession there during COVID, is what that gray bar is. Then everything reopening is the big jump up year over year growth. When you've got a lower number to start with, it's easier to have growth. But you can see that we don't have a lot of deterioration. There's still growth in sales, net of inflation. So whenever you see the word real, that means after we've subtracted off inflation. So we're actually seeing growth in the consumer area in terms of sales, which I think is really positive. It means that people have enough money to spend. One thing that's not going to be reflected yet in this chart that I am absolutely watching is the effect on tax refunds for individuals. So there's a report out, I think yesterday, the day before, in the Wall Street Journal about tax refunds are something like 11% higher than they were the year before. A lot of that is going to be towards people that are able to take the SALT deduction and not have the cap of $10,000. So a lot of our Illinois clients, you probably take an itemized deduction, whereas the previous year you did a standard deduction. So it'll be interesting to see how the influx of money into consumers, if how that plays out, and that is only a positive to spending for the rest of this year. The next area is a leading indicator, manufacturing activity PMI. This, again, is a leading indicator on the growth of the economy. As long as you're above 50%, then that means that or sorry, above a 50 number, that means that more companies are picking up activity rather than contracting. And so that leads to growth. The only times that you have contraction really are when there's negative PMI numbers. So the fact that these are positive and still going up is a really good thing for expecting the economy to grow moving forward. And then the last one is a story of how do we get these S&P 500 returns. So I talked earlier about the price earnings ratio when we talked about software stocks, but it also applies to the whole market as a whole. So S&P 500 for the first quarter was down 4.6%. The earnings grew at 7, which means the price earnings ratio, the multiple that you're willing to pay for those earnings, was down 10.5%. And so that's actually led us to a better spot to buy in, where now we're at a 79th percentile for price earnings ratio versus 93 going into the year. Another way to say that is stocks are not nearly as expensive as they were 3 months ago. And it is a better price point to buy for the earnings that you have by about 10% than it was at the beginning of the year. So uh, if you want to be pessimistic, you would say, well, if we didn't have this earnings growth, market would be down 10%, which is a true statement. But we did have the earnings growth, and those earnings so far, earnings season has already started. It looks pretty good, and those earnings numbers are being hit, and so it's not like these are fake earnings that are out there that are going to be a part of it. So, in conclusion, as we kind of think about it, it's been a pretty volatile 3 months to start the year. Our client portfolios have held up pretty well. A big part of that is having diversification, having international stocks, having real assets, having a little bit of extra exposure to energy stocks that we went into the year with. And we've had a little bit of exposure for a while. Looking ahead, I am optimistic for where the U.S. economy is going, at least for the next couple quarters. I think it's a good price point to buy in for U.S. stocks, and so as we're looking to rebalance and maybe pair off a little bit of the energy stocks, there we have plenty of places that we can buy. Another one of those areas is bonds. We have the ability to buy at higher interest rates, and so we do have clients that have a decent amount of cash that's accumulated, maybe get a tax refund, those sort of things. We sell again some assets that are up. We can buy bonds at a higher lock in a higher rate, and so that's what I would expect moving forward. So I'm pretty optimistic. I think we've weathered through the geopolitical environment so far. Again, I'm just talking about portfolios here. And so I'm optimistic looking forward, but that doesn't mean we're going to go crazy. We're not going to go sell all your bonds and buy a bunch of stocks or anything like that. Mostly stick with the program. It's worked out so far, but also look for opportunities as they present themselves. So if you have any questions, want to talk through anything for your portfolio or anything else financial planning related, feel free to reach out. Thanks for taking time.